right, welcome to the Chapter 3 overview. Chapter 3 is looking at really adjusting entries and adjusting our accounts. Some of the concepts that we have to look at with Chapter 3 are the time period assumption. This is where we actually are going to break the life of a company up into artificial time periods. And if you think about it, the reason we have to do this is who wants to know what the income was from when the company opened its doors until the company closed down? What does that really tell us? Not a whole lot. So what we do is we implement these artificial time periods. An artificial time period could be a year, it could be a month, it could be a quarter, it could be a week. It's just time periods that we put into place to help us. The most common time period that we look at is a year period. Now, companies can have different years. We do have a fiscal year. A fiscal year is a 12-month period that does not end on December 31st, which means it does not begin on January 1st. A calendar year is actually going to go from January 1st till December 31st. So it will follow a regular calendar year. Whereas fiscal years, it could be if you have a seasonal business. And if you think about schools, lots of times schools have a June 30th year end. And so that is a fiscal year. The other concepts that we're going to be looking at in this particular chapter is, as well as the rest of the class, it's going to be the accrual versus cash. What we look at with accrual versus cash, accrual basis is GAAP. All right, so that's one thing that I want you to understand right up front is that accrual basis does follow GAAP, which is generally accepted accounting principles. Cash does not follow our rules. What cash basis accounting does is it says when you receive cash, it's a revenue. When you pay something out, that is an expense. And so it is just like when cash changes hands. Under accrual basis accounting, we have a different set of rules. And our rules that we have to use are going to be two principles we're looking at this chapter are going to be the revenue recognition principle. Under the revenue recognition principle, this says that revenue will be recognized. What that means is revenue will be recorded when you have performed the service. So if you receive money and have not actually completed that service, that is not revenue to you. If you complete a service and you haven't been paid for it yet, that is still revenue. So revenue recognition looks at the performance of the service. When we perform a service, it is revenue. Now that is under accrual-based accounting, which does follow our generally accepted accounting principles. The other generally accepted accounting principle that we look at is the matching principle. It is also known as the expense recognition principle. What it looks at is that we have to match our expenses to the time period in which the revenue was earned. So if you think about it, like with our utility bills, we normally have used the utility service, we've used the power for the previous month, and then we get a bill. So when we get that bill, we have to match it to the period in which the electricity was used, not when we actually pay that bill, which would be in the following month. So with that matching principle, once we have incurred that expense, once we've used it, we would have to put that into our expenses. We are going into that next step, 5 through 7 of the accounting process. So you will remember in Chapter 1, we looked at how to analyze accounts. In Chapter 2, we looked at journalizing, posting, and preparing a trial balance. In Chapter 3, we're going to look at preparing adjusting entries. Now, these adjusting entries are also going to go into that general journal. So we do have more journal entries that we have to do. We then would have to post these adjusting entries to the general ledger, and then we were going to prepare what we call an adjusted trial balance. Now, why do we have to adjust our accounts? Why do we have to prepare adjusting entries? Well, we need our statements to be correct. We need all of our accounts to have the correct balances in them, because remember, our financial statements are not only staying within the company, they go out to other people, and other people are making decisions about our company, and we need to make sure they have the correct information in their hands. And we have to follow those generally accepted accounting principles, which include the revenue recognition and the matching principle. So in order to follow these rules, we have to make sure that we do our adjusting entries. Now, adjusting entries are required every time. Now notice, every time a company prepares financial statements. So if you are preparing a financial statement monthly, then you have to do adjusting entries monthly. If you are preparing financial statements quarterly, then you have to do these adjusting entries quarterly. All right. Now, every adjusting entry is going to have two accounts. It will include one will be from the income statement, and one account will come from the balance sheet. Because what we are looking at we are adjusting the balances on the income statement and on the balance sheet. And so to adjust those entries, we have to have one that comes from the income statement and one that comes from the balance sheet. The other thing we look at are what types of journal entries do we have that are really going to put all this stuff into place. The first type of adjusting entry that we have are what are called as deferrals or prepaid items. They can consist of prepaid expenses. Now remember, prepaid expenses are things like prepaid insurance, prepaid rent, even supplies. Now remember, supplies is also one of those prepaid accounts. The other thing that we look at is on the revenue side, and we look at unearned revenue. So these items, money has already changed hands. So for our prepaid expenses, we've already paid for them, and as we use them, we have to expense them. And so that's why we have adjusting entries, is so we can move it from that asset account into an expense account as it's used. For unearned revenue, we've been paid, but we haven't performed the service yet. As we perform those services, we have to move that money out of that liability account and into our revenue accounts. And so that's what we're going to be looking at for deferrals or prepaids. Just remember, money has already changed hands when we look at those types of accounts. The next section we're going to look at is the accrual section. Now, with the accrual section, money has not changed hands yet. We have two types. We have accrued revenues. Now, when we look at accrued revenues, what this is saying is we have performed the service, but we have not been paid yet. So when we look at accruals and we're looking at these accrued revenues, we are going to be looking at that accounts receivable account for that. So we are going to have to make sure that we increase our accounts receivable and we increase our revenue account for these different accrued revenues. When we look at accrued expenses, these are items in which we have already used. Like our utilities. We've already used our utilities for that month, and so we have to make sure that we put that into our books. And so with those, we will be using liability like the payable accounts. So, other items are wage expenses. If somebody's worked for the month and you haven't paid them yet, then you have a wage payable. For interest, if you have an interest account out there and you haven't paid that interest expense yet, then you have an interest expense and an interest payable. So remember, accruals are when money hasn't changed hands yet. Now, for adjusting entries, I'm going to tell you right now, there is an ugly 4-letter word that I do not want to see you use. Please, please, please do not use the word cash. Cash is not used in adjusting entries. That is a very, very bad word. We do not want to see cash with our adjusting entries. Cash will never, ever, ever be used with adjusting entries. So please, when you're looking at your quizzes, when you're looking at your test and you are doing adjusting entries, you will not use cash. All right? And so that's just a brief overview of what this chapter holds in it. I will come back later and we will actually look at preparing these adjusting entries.